Markets are frequently described as systems that reward intelligence, discipline, insight, rigorous analysis, careful reasoning. The narrative is appealing because it feels fair. Apply enough skill and the market eventually recognizes it. But if you observe markets long enough, a quieter truth begins to surface. Markets do not simply reward wisdom, they structurally rely on its absence. Not stupidity in the obvious sense, something more ordinary and more human than that. Overconfidence in a thesis held too long. Impatience that cannot survive a drawdown without reacting. The desire to believe a compelling story more than the evidence actually supports. These are not rare pathologies found only in amateur investors. They are consistent, recurring patterns observable across every market cycle in recorded financial history. Every trade requires two participants who disagree about the value of the same asset. One believes the price is too low, and the other believes it is high enough to sell. Over time, one of them will be wrong, often significantly wrong. The market does not eliminate this dynamic through efficiency or information flow. It depends on it continuing. Without persistent behavioral error creating mispricing, the opportunities that reward patient capital largely disappear. The market does not eliminate fools. It quietly and structurally depends on them remaining present. Consider what a perfectly rational market would actually look like in practice. Prices would reflect all available information immediately and completely. Every participant would act with patience proportional to their time horizon. Nobody would panic during volatility, because volatility would be understood as noise. Nobody would chase rising prices, because the chase itself would be recognized as the signal to stop. In such a world, mispricings would correct faster than any individual investor could exploit them. Opportunity, in the meaningful sense, would nearly vanish. But that is not the market that exists. The market that exists is populated by people responding to headlines before reading them carefully. People selling because a price is falling without examining whether the underlying value has changed. People buying because the chart is rising and the momentum feels like confirmation of something real. People concentrating into whatever has performed best recently, which is precisely the behavior that transfers wealth most reliably from one group to another. These behaviors introduce persistent distortions between price and value. Those distortions are not market failures in any final sense. They are the mechanism through which patient capital gets rewarded at all. Without the overconfident buyer paying too much, the disciplined seller has nobody to sell to at a reasonable premium. Without the panicked seller accepting too little, the patient buyer cannot acquire quality assets at attractive prices. The emotional participant is not incidental to the market's function. They are integral to the return available to everyone operating on a longer time frame. The distortions are the opportunity, and the opportunity persists because human behavior does not change as quickly as information does. One of the more surprising and consistently documented patterns in behavioral finance is this: intelligence alone rarely protects people from behaving foolishly in markets. In a number of specific ways, it makes the problem considerably worse. Intelligent people construct more convincing narratives around their positions. The analysis is thorough, the logic is coherent, the thesis feels genuinely well supported, which means that when the market moves against it, there is more internal justification available for holding on. More reasons to interpret the contradicting price action as noise rather than signal. More confidence that patience will eventually produce vindication. Intelligent investors defend their views more forcefully than less confident ones. Public commitment to a thesis creates social and psychological reinforcement that operates independently of whether the thesis remains valid. The more eloquently the position has been argued, the harder it becomes to reverse without experiencing it as an intellectual defeat. Being right becomes identity in the way described in previous episodes. And identity is a very poor foundation for sound financial decision-making. Markets do not reward the most persuasive explanation of why something should happen. They reward the most stable and adaptive behavior sustained over time. The investor who can acknowledge genuine uncertainty without discomfort has an advantage. The investor who can update their position when evidence changes without ego involvement has an advantage. The investor who can remain patient while the people around them are reacting emotionally has an advantage. Not because they are smarter in any measurable cognitive sense, but because they have separated their behavior from the psychological patterns that markets consistently exploit. If markets run partly on persistent behavioral error, the practical question becomes straightforward. How does an investor avoid being the consistent source of that error? The answer is considerably less glamorous than most people entering markets initially expect. It is rarely about predicting what happens next with superior accuracy. It is almost entirely about controlling your response to what is already happening, not chasing every opportunity that generates excitement and social confirmation, not reacting to volatility as though short-term price movement carries long-term significance, not confusing visible activity with actual progress toward a financial goal. The investor who remains behaviorally stable while others become emotional occupies an unusual structural position. They are not competing primarily on the quality of their analysis. They are competing on the quality of their responses under pressure. And those two competitions have very different distributions of outcome over time. Analytical edge is difficult to sustain consistently because information advantages erode quickly. Behavioral edge compounds because the conditions that produce emotional decision-making in others do not disappear. Market cycles recur. Human responses to fear and greed remain consistent across them. The patient investor does not need conditions to change in order to maintain their advantage. They simply need to continue behaving differently from the majority of participants. That sounds straightforward in calm conditions. It requires genuine psychological infrastructure to sustain through volatility, underperformance, and the social pressure of watching others appear to profit from exactly the behavior being avoided. Behavior maintained consistently over long periods compounds in ways that individual analytical advantages rarely match. There is an irony sitting at the center of everything discussed here. The opportunities available to the disciplined investor exist because someone else is behaving poorly. Every attractive entry price reflects a seller who needed liquidity, panicked, or lost conviction at precisely the wrong moment. Every overvalued exit reflects a buyer who chased performance, believed a story too completely, or confused recent price action with durable value. The rational investor benefits structurally from the emotional behavior of others. But here is what is worth sitting with, honestly. Anyone can become that person at any moment. The line between the disciplined investor and the fool is not a fixed boundary determined by intelligence or experience. It moves with emotion, with pressure, with fatigue, with the particular character of a specific market environment. The cycle that did not cause you to behave foolishly was not necessarily a demonstration of permanent immunity. It may simply have been a cycle that did not find the specific combination of pressure and circumstance that would have moved you across the line. This is not pessimism about human nature. It is an honest accounting of the conditions under which behavioural errors reliably occur, which is precisely why the most durable advantage in markets is not analytical brilliance. It is structural humility. The quiet and operational understanding that you are capable of being wrong, that you are capable of being the source of error rather than the beneficiary of it, and that building systems which protect against your own worst responses is more valuable than any forecast. Markets may run on fools, but the investors who last the longest, who compound the most quietly, who survive the cycles that eliminate others, are the ones who never fully assume they are immune.